I open the presentation by introducing the core theme, examine the nonlinear dynamic relationships among market sentiment, stock returns, and volatility. The analytical tool is a threshold VAR model, which allows us to capture regime-dependent mechanisms. I will now formally present the study. The presentation is structured into 4 logical parts. The first part covers the research background and the specific questions we address, clarifying the academic value and the research gap. The second part explains the research design, data sources, and the specification of the threshold VAR model. The third part presents the empirical results and diagnostic tests, and the fourth part concludes with key findings and policy recommendations. We now begin with the introduction, which establishes the foundation of the study. It explains the motivation behind this research, why we choose this topic, and how our work feels. We now begin with the introduction, which establishes the foundation of the study. It explains the motivation behind this research, why we choose this topic, and how our work fills an important gap in the existing literature. This helps the audience understand the range and purpose of our investigation. Traditional finance relies on the assumptions of rational investors and efficient markets, but behavioral finance challenges this view, showing that investor sentiment can push prices away from fundamental values. In China's capital market, volatility has increased, notably in recent years, while margin trading has become highly active. Traditional finance relies on the assumptions of rational investors and efficient markets, but behavioral finance challenges this view, showing that investor sentiment can push prices away from fundamental values. In China's capital market, volatility has increased notably in recent years, while margin trading has become highly active, allowing panic to spread quickly through leverage and amplifying systematic risks. Most existing empirical studies, however, adopt linear frameworks and ignore the regime-switching nature of financial markets, leaving a clear research gap that we aim to address. A substantial body of literature, both international and domestic, has confirmed that sentiment significantly affects returns, volatility, and financial stability. Chinese studies have specifically identified how investors' sentiment interacts with macroeconomic fluctuations in the A-share market. On the methodological side, TESS's threshold VAR provides a basic non-linear framework, and Hassan's subsequent improvements on estimations and inference offer a solid foundation for our empirical design. Having reviewed the background and identified the gap, we now transition to research design section. Here we detail the rationale for choosing the TVAR model and explain how it tests nonlinear interactions across different market regimes. The following slides will cover data selection, variable definitions, and model specification in more depth. Our analysis incorporates 4 key variables. The return of the All A-share index represents overall market performance, and the growth rate of trading volume serves as a proxy for liquidity, and investor participation. Global panic sentiment is captured by the CBOE VIX return, while domestic leveraged investor sentiment is measured using margin financing and short selling data from Shanghai and Shenzhen. All data are daily observations spanning from September 2017 to April 2026, obtained from Nonlinear data and CBOE, ensuring timeliness and representativeness. All selected variables exhibit typical properties of financial time series, including volatility clustering, which confirms the contagious nature of market risk. In addition, the distributions display asymmetry and fat tails, implying that extreme market events are more likely than would be predicted under a normal distribution. These characteristics are consistent with the heightened volatility observed in the A-share market in recent years and provide a valid empirical basis for our nonlinear modeling approach. We employ a threshold VAR model that divides the market into two regimes: low volatility and high volatility, and estimates separate equations for each. The VIX return is chosen as the threshold variable, as it captures the triggering effect of global fear on regime transitions, and the critical threshold value is estimated endogenously. Augmented Dickey-Fuller tests confirm that all variables are stationary at the 1% significance level, ensuring reliable estimations of the model. With the research design, variables, and model construction established, we now move to the core empirical analysis. This section tests whether and how market responses differ under various sentiment regimes. We begin by presenting the estimated threshold and then proceed to the impulse response results and other diagnostic checks. The estimated optimal threshold is negative 0.0541 for the VIX return. Out of the total 1,619 daily observations, 405 fall into the high panic regime, accounting for roughly 1/4 of the sample. The AIC and BIC criteria both select a second-order lag specification, so we adopt a TVAR2 model as the final framework for all subsequent analyses. The coefficient estimates for the VIX return are significantly larger in the high panic regime than in the low panic regime, indicating that the transmission of fear sentiments for financial variables is much stronger during periods of elevated panic. The margin financing growth coefficient is only marginally significant in the high panic regime, which supports the theoretical argument that leverage amplifies risk during turbulent market episodes, and our results provide empirical evidence for this amplification effect. Impulse response analysis shows that a positive shock to VIX return has a significantly negative impact on stock returns, with the decline being larger and more persistent under the high panic regime. Trading volume growth responds positively to VIX shocks, exhibiting a rapid increase and a sustained fluctuation, confirming that panic alters investor behavior and liquidity dynamics. The identification relies on Kolesky decomposition with a 15-period forecast, horizon and 1000 mode Carlo simulations to construct 95% confident intervals, ensuring the statistical robustness of the findings. After completing the threshold estimation, model estimation, and impulse response analysis, we have obtained a set of detailed empirical results. Now we synthesize these findings to extract the main conclusions and discuss their implications for market regulation and systematic risk management. The next slide summarizes our core takeaways. Our key conclusions are threefold. First, sentiment exerts significant effects on A-share returns, trading activate and margin financing behavior, and the dynamics are. Our key conclusions are threefold. First, sentiment exerts significant effects on A-share returns, trading activity, and margin financing behavior, and the dynamics are inherently nonlinear. Second, risk transmission exhibits clear regime effects. High panic leads to stronger and more persistent contagion, creating a positive feedback loop that exacerbates instability. Third, leverage further amplifies sentiment-driven fluctuations, increasing the fragility of the financial system. These findings call for stronger leverage risk controls, improved early warning mechanisms, and proactive measures to ensure the stable functioning of capital markets. In closing, I thank the audience for their attention. This empirical study based on A-share data from September 2017 to April 2026 clearly verifies that sentiment, returns, and volatility are linked through nonlinear channels, with high panic and leverage jointly intensifying systematic risks. We hope to translate these research outcomes into practical tools for risk monitoring and leverage management, contributing to the resilience and high-quality development of China's capital markets in a volatile global environment. Once again, thank you for your time.